IndiaBonds presents CNBC TV 18, India's Fixed Income Summit, powered by Mirae Asset Mutual Fund.
I welcome all of you to the India Fixed Income Summit. When I joined the fixed income market in the mid-90s, we already had a developed fixed income, we already had a developed debenture market. Up until, 2021, AUM of debt was always higher. And then came the tax blow. Indexation gone, interest rates raised to slab rate, and then you saw from 2022 onwards, debt was growing, but equities was galloping. I want a round of applause for people like Vishal and Aditi, because this online platform has given retail investors a chance to buy debt transparently. It is a very good beginning that the online platforms have done, and we can only go from strength to strength from here on. That at least is my hope, my prayer, and my ardent wish. With that emotional outburst, let me welcome all of you once again. I wish you a happy evening. Thank you very much for coming once again.
Very warm welcome to our markets, a market which is the future of India, future of infrastructure, and the future that will make all of us wealthy and prosperous and will take us to Viksit Bharat. I started in this market when corporate bond markets were just a footnote to the Indian financial landscape. Today, it provides what? It provides to a company a credible alternate to bank financing. The bond market has given them the alternates, and at times in a very, very attractive pricing. Now I'm going to give out some numbers. As of 31st March 2026, the size of Indian bond market stood at US $2.76 trillion. In this, 77% is G-Secs and SDL. And only 23% is corporate bonds. As on 30th April 2026, there are approximately 4.5 crore active Demat accounts. Guess how many of them has corporate bond in their Demat accounts today? Only 5.5 lakh accounts. So corporate bond first has to reach every Demat account, and every Demat account has to reach to every Indian. That is what is our journey. In financial year 25-26, 28 lakh transactions aggregating to 21 lakh crore were executed on corporate bonds on stock exchanges. So numbers simply suggest that the market today is democratizing and witnessing participation from non-institutional investors, smaller investors in dramatically large numbers. SEBI's ticket reforms, gradually reducing face value from rupees 10 lakhs to 10,000, has been a complete boom. India's bond market is not at its ceiling. We are not at the end of the story, my friends, but we are somewhere in the middle. And with that middle, I would say that it's not the end of the story, and I firmly believe that the second half is going to be very, very exciting and very, very prosperous. Thank you, everyone. I hope you enjoyed today's event.
For decades, bonds and fixed income largely remained in the background of financial conversations. And now suddenly something is changing. You can buy a bond in 5 minutes lying on the beach on your holiday. Every major financial innovation in the country actually starts with infrastructure before products. With infrastructure comes the trust layer for the masses. And we're very thankful to our regulators, our exchanges, our clearing corporations, our trustees, for rapidly establishing that infrastructure to build the trust in the bond market. If India were to do a $7 to $8 trillion bond market, capital is not going to come only from equity or the banking system. Infrastructure needs long-term capital. Companies need diversified source of funding. Individuals need asset allocation. Household needs more than traditional avenues. A mature economy needs a mature debt market. We are deeply grateful to all our regulators, institutions, issuers, sponsors who have agreed to participate today and tell us something more that they know. Thank you everyone for joining us today. Like we say in IndiaBonds, a bond in every hand.
It gives me great pleasure and privilege to address all of you. Just keep in mind how important trust is. And if trust goes, how long-lasting the damage is. So We have had to start afresh in bond markets because of what happened in the early 90s. There are a lot of exciting moves happening in bond markets, some of which will strengthen and deepen existing measures and some which are completely new, but will offer new solutions to old problems. Here, I want to say that we recognize that bond market is 99% privately placed. We recognize the fact that OBPPs are the channel which take this private placement down to the retail investors. It's a model which is very different from what has happened in the equity markets. We recognize this model. And in this context are the concerns on pricing. So those need to be addressed. We look forward to more trading volumes in secondary market transparency through the RFQ platform. We look forward to more liquidity through market makers, better funding through a more active repo market, risk management through derivatives, retail access through OBPPs, issuer expansion through outreach programs, and investor confidence through disclosure, surveillance, and enforcement. Here, I want to go back to the idea of trust. A bond market is ultimately a market of trust, a promise of payment, truthful disclosure, fair markets, vigilant regulation, and reliable exit. SEBI's role is to protect that promise, but no regulator can build this market alone. Trust has to come from the players in the market. We can act after trust is broken. Trust must not be broken, because after trust is broken, it is already too late. So every stakeholder, all of them must play their part with discipline and integrity. Let this summit mark the shift from discussion to decisive action. A vibrant, liquid, transparent, and trusted bond market will finance our ambitions, lower the cost of capital, protect investors, and power the rise of Viksit Bharat. Thank you.
We have all those people who have given us a platform and who have leveraged the technology to ensure that the bond markets are as transparent, as quick as the equity markets. And that is where I'm going to start. Vijay, with you actually. Tell us the positive side.
I think the starting point in some measure was the regulation enablement coming from SEBI, the OBPP sort of framework that came. We've seen the bond market finally widen to attract more retail investors. When we talk to people who are in this business, the OBPP business, we hear a lot of excitement. The numbers they talk of is not 30% growth, 20% growth. They talk of 4x, 3x in a year's time. I think the whole infrastructure setup of behind the OBPPs has started improving. Technology has improved access. The most important factor is trust. People, I can clearly see finally some element of trust, because things are becoming more real time. He's able to see his portfolio. He's able to, to some extent liquidate. He gets quotes on a regular basis. It is becoming more equity-like, which has led to so much of growth.
Vikram, since as clearing corp, you would be the last word in terms of telling us whether the technology is finally full and complete. Would you say it is now as frictionless a market as in equities, or do some one or two things remain to be done?
From the way the structure is there currently and the way we've been growing and we've been handling the volumes and transactions, as well as agile in terms of integrating the retail OBP platforms, I think it's there. It's all about scalability right now, because the way we've seen the volumes grow, specifically if you look at the last 2 years of post-OBPP era, where now on an average we see around 7,000 trades daily, and at peak we've handled around 31,000 trades. And we would firmly like to believe that our capacities currently is to handle at least more than 2 times of what we are. But in the next 1 year, from a technology perspective, what we aspire is that at least from the peak that we've seen, we should have a 5 times capability in maybe say the next 6 to 8 months. Technology, I think, is firmly there. The bed is out there. And I think now we are waiting for that distribution framework, which will take the volumes up. And we'll have the capability.
Okay, I'm waiting for something else. And let me ask Srirab that. It is still a AA plus market. What would you say is the missing link to get at least to A and BBB plus?
The psyche of the investor in India has got tuned towards the credit rating. And therefore, without credit rating, oh no, this could be risky. That's how people look at bonds in general. Whereas in the US, companies are heavily encouraged to go and list their bonds. Don't worry about the banks. The banks are there for short-term lending. Bonds is where you need to get your long-term money. That's how the inherent nature of the beast is. So therefore, I think we missed a trick somewhere by insisting on credit rating. Secondly, I think we've never allowed the retail to face off with the institutional clients for some reason. The corporate bond trading always seems to be happening amongst the institutional players, and the retail is simply kept out. Only now in the recent couple of years, we've seen the OBPP slowly coming in and explaining what these corporate bonds and the debt-focused instruments can bring to a portfolio. Thirdly, I think we need to think about how technology can make this happen. Investing in bonds looks like very threatening. You look at a company, they have so many issuances. It's not like equity where you go buy Infosys, that's it. There's just one icing. So this concept of investing in bonds itself is not seen as so easy to do. You might make a mistake, you might choose the wrong bond. That's the kind of complexity. Therefore, even the RFQ platform, although it's a great initiative, it's still struggling. It's still being used like a reporting platform and not really a platform that should get better deals for an issuer of bonds.
Vijay, you form a very important piece over here. In the last 2 years, when we have seen this huge capital outflow by FPIs, the ones that have been sticky are actually the bond. So do you think the doors are sufficiently wide open?
The FPI limits on corporate bonds, if I'm not wrong, is only 20% utilized.
Yes.
Approximately, right? So still there is an 80% room for it to be utilized. Number two being that now there is definitely an yield kicker for these guys to really come in. So there is, the spread is widening. And thirdly, with the inclusion of the Indian sovereign bonds in the international indices, that's actually been a significant step in the last year that has happened, which is actually slowly started getting the kind of proportion of the FPI investments back into the country. Having said that, is it going to fully open the doors, or there are still things? The taxation is a bigger issue. I would say the platform is well set. Some changes in the policy, some parity with the other asset classes, which is far more riskier than bond market. If there's a parity, I think so that it will open the doors furthermore for all of these investments to come in.
Time is up, but I want to put one question to vote. How many of you think that tax is the biggest obstacle of the debt market? Hands up for those who agree. Okay, we rest our case. Thank you very much, ladies and gentlemen.
IndiaBonds presents CNBC TV 18, India's Fixed Income Summit, powered by Mirae Asset Mutual Fund. IndiaBonds presents CNBC TV 18, India's Fixed Income Summit, powered by Mirae Asset Mutual Fund.
The question we're asking is where we are in the credit cycle. So let me just put that exact question to our panelists one by one. Why don't you kick this off, Krishnan?
We are in a benign credit quality environment. And if I look at, say, corporates or even financial sector entities, balance sheets have improved over time. So if I look at CRISIL's rated universe, and if you look at, say, the leverage levels, the median gearing has halved over the last decade. Interest cover ratios have more than around double, 2.7x to 5.2x. And if I look at financial sector entities, again, asset quality has improved, provisioning cover has improved. Companies have a lot of cash on their balance sheet. So overall, we are in a I would say, benign credit quality environment, but credit cycles come up and down. Credit quality can deteriorate, and we need to keep that at the back of the mind. Robust credit assessment is the need of the hour.
Suyash, you want to sort of jump in there? Your assessment?
I think it's becoming very much more sector specific because given the context of the war and, so there's multiple shocks that the system is facing over a period of time. The other thing is, over the last few years, you have had a very large retail leverage cycle, but the starting point was very large or healthy amounts of capitalization. So clearly, you're not seeing much there. And you also had, corporates starting with very benign balance sheets, and you haven't had much of a capex cycle, which would draw that, kind of resourcing out. But I would say we are, in essence, in the midst of a funding shock, which is coming from a sustained period of balance of payment deficit. And so the country level lack of dollar funding is percolating into liability side, funding, I would say, stresses in terms of availability and cost of capital across the board. And on the other side, you are seeing probably a once in a decadal, if not more, shock from the commodity cycle suddenly flaring up. The lack of the India-US deal probably pressuring the SME, MSME sector. So not so much of the credits that we as mutual funds get exposed to, because most of what we are talking about may not be issuers in the market. But I was just caution, that things are different for different people now, and there is a generalized, need to right price. Because if you're the holder of capital, you are, basically the setter of the narrative right now.
Kruti, you want to sort of address that? Just a quick assessment.
Yes, there is a stress, there is economic stress that we see because of balance of payments. Obviously, we see other credit to deposit ratio has also widened a lot. But given that the systems are in place and we are now, before we used to be more reactive, now we've become more proactive when it comes to regulations also, or any measurement that has to be taken. Therefore, this feels that we will go through this cycle smoothly, rather than there obviously will be pockets of it, because ultimately credit cycle is a function of what derives from the economic measures, right? So how long the situation goes on, obviously it will be a derivation of it, but if it is something that we can contain it, or it is short-lived, then we will see that we will flow through this cycle very smooth.
I mean, your thoughts?
The best of balance sheets improvements are behind us, which does not mean that balance sheets are looking bad right now, but incremental improvements are very difficult to come by from here on. The second is, if you just segregate corporate credit and retail credit, on the retail credit side, cash in the consumer hands is slightly better right now in the last 6-8 months. That's what you refer to when you talked about the consumption cycle. But there is a K-shaped element to that, so we have to be careful on that side. There are parts which are doing very well, there are parts which are not. We are today, as an economy, struggling to fund a 13% credit growth, which means that somewhere the market infrastructure is becoming an issue. This is a macro structure issue. And the second macro structure issue which we need to address is this complete breakdown in terms of transmission, at least as far as debt capital markets are concerned, vis-a-vis the policy rates. So somewhere I think we need to manage the macro level issues properly at this point in time, so as to ensure that the liquidity issue does not convert into a credit issue in the near term.
A quick 10-second responses. I mean, say this entire Iran issue and oil settles and it cools off a little bit. What are the 1 or 2 things you'd watch as you look ahead in the next 12 to 18 months with regards to the credit cycle? I mean, what are going to be the sort of markers? How would you assess how strong or how weak this cycle is going to be? Suyash.
So first and foremost, the re-anchoring of market rates to RBI policy rate. From there, a reasonable volatility to credit spread pricing. So today, you're in an environment where the non-SLR curve moves by 50-60 basis points over 3 or 4 weeks. And then, take it from there. Like I said, it's a very disparate credit market right now. So there are parts of it where you have had 20% CAGR growth rate for 5 years. There are parts of it where there is excess capital, etc. So that part you can basically figure out bottoms up.
Krishnan?
I think 2 things. I would say interest rates and interest spreads stabilizing or coming down, and investors starting to move down the credit spectrum. These 2 are important for stability to come. Because the other thing that why I'm saying that is because today AAA corporate is also going to the banks to borrow rather than from the capital markets, because he's getting finer rates there. So there needs to have some semblance of stability.
Kruti?
Credit to deposit ratio, as we are already watching, and how the NBFC spreads are moving, because NBFC is the key pillar where your small industries get financed, and if there the stress is coming, then probably it's a wake-up call. So credit to deposit ratio.
Amit?
I think we should just work on allowing the markets absorb this risk. So let's just work on the infrastructure part. We should make sure 18 months down the line, if any investor has the risk appetite, he should not be unable to buy a bond just because of lack of capital. So just make the repo markets work. it does not matter if the EPFO does not buy AA bonds or single A rated bonds. If I have the risk appetite, unfortunately, I don't have the capital and he has the capital, right? So you only need to move capital from people who have money to people who have risk appetite. Repo is the only way to do it. Just do it properly and the markets will become much more liquid. We'll be able to handle some of these stresses much more easily.
Thanks very much for being a wonderful audience. Thank you. Thank you, Basant, for being here. How people view bonds. I mean, either the long-held view always has been that, well, either chase growth, buy equities, or go absolutely safe, and then you sort of start thinking about fixed income. So has that balance started to come through, in your opinion?
If you look at the overall asset allocation of investors, and especially when you look at through the mutual fund route, retail investors are increasingly tilted, and they've continued to do so by way of either equities or hybrid funds. But if you look at fixed income, I mean, as an asset allocation, it's been significantly minuscule. And if you look at the money that's lying in traditional bank deposits, it's significantly higher. And when you put money in a bank, I mean, of course, banks also look at their asset liabilities, right? Typically, you have floating rate linked assets, which is significant in your balance sheet. And to fund that, your overall requirement of funds is broadly concentrated in the shorter end. So that's why your bank FD rates are primarily the best in the 1 year part of the curve. But that is something that suits the asset ALM of the bank, right? But when I look at an overall asset allocation, and if I have an asset liability requirement, then you sort of try to blend your asset liability requirement based on the underlying balance sheet of the bank. But if you have a specific requirement, say for example, if I want to buy a house and I want to accumulate funds, say over a 5-year period, because I have a plan in the future, the rates that markets offer and is significantly higher, and at the same time, you don't get exposed to the kind of refinancing risk that's there when you are sort of looking at investments. And when you look at the rate disparity between what the traditional bank deposit offers and what markets are currently offering, there is a huge disparity, because when you look at the underlying markets, when you look at, say, for example, OIS, and which is again seeping through into the overall credit markets, the disparity between rates is quite significant. You have overnight rates which are ranging within the lower end of the LAF corridor between 5 to 5.25, and at the same time you have CD spreads, AAA PSU, which are ranging, at least for 3 months also, you are having spreads at close to 225 basis points, which is quite significant, as close as a crisis period. So when I look at myself as a retail investor, if I have, for example, a short-term requirement, why don't I try to maximize that and try and at least get that benefit into my own balance sheet, and at the same time get my liquidity at a time when I really need it. The liquidity availability which is there for mutual funds and the kind of products that are available across the suite, that's sort of something that investors can always harp on and try and maximize their overall gains.
Thanks very much, Basant, for a great chat. Appreciate you joining us here on stage. Thank you very much.
Thanks, Prashant.
IndiaBonds presents CNBC TV 18, India's Fixed Income Summit, powered by Mirae Asset Mutual Fund.